Today, we're going to do a little financial archaeology. We're digging into the wild world of mortgage banking, all by looking at one single, really fascinating document, a rule book that ran a multi-trillion-dollar industry right before it was completely thrown out. Let's find out why. Okay, so this is it. This is our artifact, the Comptroller's Handbook for Mortgage Banking. And right there, on the cover, is the whole mystery. I mean, look at that giant red stamp, rescinded. This book, finalized in 1998, was basically the playbook for the entire industry, until 2014 when they just tossed it. To figure out why, we've got to figure out what's inside. So, let's start at square one. According to this handbook from the 90s, what exactly is mortgage banking? Well, it turns out it's probably not what you think it is. It's a totally different beast than your normal, everyday banking. Think about it like this. A traditional bank, the one on the corner, makes a loan, say a 30-year mortgage, and they plan to just sit on it for 30 years and collect the interest. But a mortgage bank? No way. They have absolutely zero intention of holding that loan. Their business is to create loans just so they can sell them. It's not a vault, it's a factory. And where are they selling all these loans? They sell them on something called the secondary mortgage market. You gotta understand, this is the engine that makes the whole machine go. It's this huge marketplace where mortgages get bought and sold, bundled up, and traded around. For the banks, this is just fantastic. It frees up their cash so they can make even more loans, and they get to collect all kinds of fees. It turns a single loan into a business that just keeps on giving. Okay, so if a mortgage bank is a factory, what does the assembly line look like? Right? How do you go from a simple loan application someone fills out at their kitchen table to a financial product that can be sold to big shot investors anywhere in the world? Well, the handbook breaks it all down for us into four main stages. You've got loan production, then pipeline and warehouse management, then secondary marketing, and finally servicing. Every single one of these stages is a critical piece of the assembly line, and as we're about to see, every single one of them is loaded with risk. So let's do a quick walkthrough. Production. That's where the loan is born. It's all the applications, the paperwork, the underwriting, the approvals. The pipeline, or the warehouse, that's like a holding pen where the finished loans sit and wait to be sold. Marketing is the crew that goes out, finds a buyer, and sets the price. And then there's servicing. That's the long-term part, collecting the checks every month and managing the account even after the loan has been sold to someone else. And this brings us to what might be the most brilliant and most important idea in this entire handbook. See, when a mortgage bank makes a loan, it isn't just creating one thing. It's actually creating two. That's right, two for the price of one. Every single time a mortgage is created, two separate, valuable, and tradable assets pop into existence. This is the real secret sauce of the whole business. So the first asset is pretty obvious. It's the loan itself, the actual debt. But the second asset is something called a mortgage servicing right, or MSR. This is literally just the right to be the company that collects the payments and manages the loan. And here's the kicker. That right can be bought and sold all by itself, completely separate from the actual loan. So that's the whole game right there. The entire business model is to manufacture these two things, the loan and the servicing right, for a cost that's lower than what you can sell them for on the open market. It is a high-volume manufacturing operation, pure and simple. But, a factory that cranks out financial products at high speed, well, it's filled with hidden dangers. And the handbook spends a lot of time talking about all the ways this business could go completely sideways. This is the stuff that was keeping regulators up at night back in 1996. And the list is, well, it's pretty long. You've got credit risk, interest rate risk, transaction risk, price risk, strategic risk. These aren't just buzzwords. Each one is a trapdoor that could make a mortgage bank lose a ton of money, like really, really fast. Let's just look at a couple of the big ones. Interest rate risk is the perfect example of the crazy balancing act these banks have to pull off. I mean, look at this. It's a total catch-22. If interest rates go down, what does everyone do? They refinance. For the bank, that's terrible news because that valuable servicing right they owned just went up in smoke. Poof, gone. But if interest rates go up, then nobody wants to get a new loan, so the factory slows way down, and the loans they're holding in their warehouse are suddenly worth less. They're basically trapped no matter which way rates go. And credit risk, you might think that's just about a homeowner not being able to pay their mortgage, right? Nope. It's way more complicated. The mortgage assembly line has all these different players: brokers, closing agents, insurers, investors. If any one of those links in the chain breaks, the whole thing can fall apart. The handbook itself just lays it out there perfectly. Listen to this. It says this whole business is a game of volume and efficiency. And if you don't control the risks in the process, the transaction risks, you can have substantial losses. Basically, the factory's speed is its biggest strength, but it's also its biggest weakness. So now we have a pretty clear picture of what mortgage banking was like back in the late 90s. A super fast, super risky financial factory. Which, of course, brings us all the way back to our big question: why on earth was this entire rulebook thrown in the trash? We've dug through the pages, we've seen the business model, we've looked at the risks. But maybe the most important clue isn't actually what's inside the book, it's the date they decided to get rid of it. Just look at this timeline for a second. The rulebook gets finalized in 1998, and then nothing. For 16 years, a decade and a half, this was the playbook. Then, boom, February 2014, the whole thing gets rescinded. That is a huge gap in regulatory time. So you have to ask yourself, what happened between 1998 and 2014? Well, pretty much everything. That mortgage factory we've been talking about, it went into hyperdrive. And all those risks we outlined, the credit risk, the interest rate risk, the transaction risk, they got magnified on a scale that the people who wrote this book probably could have never, ever imagined. The system they were trying to put guardrails on was about to go completely off the rails. When you look at it, this document is like a time capsule. It's a perfect snapshot of a system right on the edge of a cliff. It details all the machinery, it maps out all the known dangers, right before that machinery got pushed way, way past its breaking point. Which leaves us with one last massive question. What could possibly happen in the world that could make the entire rulebook for a multi-trillion-dollar industry totally and completely obsolete?